Okay, awesome. So I think the best way to make these calls as functional as possible is to leave yourself on mute. If you have a question, you can type it. If you have something you'd like to follow up with, then we can, sort of talk to each other. There's not that many people on the call. It looks like only a dozen or so for now. But that way we avoid talking all over each other. So the purpose of this call is to just talk a little bit about what's going on in the markets, how to approach them as retail investors, how to sort of manage yourself through this emotionally and from a risk management perspective, just give you a little bit of clarity and maybe just kind of calm everything down a little bit in terms of approach to the markets. My background is prior to all this entrepreneurship stuff that Nancy and I have done together over the last 10 years almost or so was in capital markets. So what that means is I traded a lot of risk on behalf of really some of the largest financial institutions in the world. So I moved a lot of money around the globe in terms of currencies and derivatives and interest rate products and swaps and all that stuff that nobody really cares about, but did manage a lot of risk through a lot of extremely volatile periods. And so we were getting a lot of questions here from people about the markets and things like that. So I want to address this approach to risk management as a retail investor and share with you what I learned as an institutional investor. What I won't do is give you specific advice about where markets are going, higher, lower, whether a particular investment is a good investment or not. I'm not licensed to do that, and you should be doing that in conversation with your licensed professional financial advisor. I'll certainly steer you towards information and data and the things that I look at and the approach that I take to trying to make decisions in a sort of level and balanced way, but I'm not going to tell you something's low or something's high or buy now or sell now. And I'll probably say that more than once through the course of the conversation. So what's a quick snapshot of the market now? And when I say market, I'm going to mostly be talking about equity markets. You'll hear me refer to the US equity markets a fair bit. That's kind of the ones that I follow, but you can more or less say the same thing for Canadian equity markets. When I say equity markets, I mean the stock market. So the Dow or the S&P in the United States and the TSX in Canada. So they're down about 30%, all three of those markets from the highs of where we were maybe back in February. Obviously, what the stock market is doing and what the stock market always does is try to discount the future. So the market is trying to look ahead and determine what the economic damage is going to be for individual companies. And as a result, those indexes, the S&P and the Dow and the TSX move up or down, in this case, down a long way, because the future is being discounted in a negative way, and it's only natural that the market does that. So right now, the market's down 30%. So that's probably the fastest that the stock market has ever come that far in this short period of time, because this is just such a drastic shock to the economic system. So all sorts of sort of votes are being cast into the market, and these days it's mostly about selling. Because we're trying to discount the future. The thing with the stock market is that it can move pretty quickly, and right now it's discounting a bad outcome, but the market doesn't ring a bell and tell you when it's going to start to discount a positive outcome. And I don't know when that is. It could be another 20% lower from here. It could be this is the bottom here. I mean, I just don't know, and I don't think anybody else does either. So you need to sort of be prepared for continued volatility, I would say that. I had a question around, let me just pop it up here, from Tom. Where's your question, Tom? About the movement in oil and Canadian stocks and bank stocks in particular. So oil is down around $20 a barrel. US WTI, so that's a bad thing for Western Canada. It's a bad thing for oil producers. It can be a bad thing for Canadian banks who have a lot of exposure to Canadian energy producers. So there's kind of some knock-on effects, particularly for Canada, with oil being down as low as it is. I don't know that we've seen oil much lower than these low 20s. I think it got down to the teens maybe 20 years ago. So when you're looking at something, commodity like oil, and you see it was trading $55 a barrel a month ago, and now it's trading at $20, and you think, wow, that's low. You need to be careful with that approach when you're managing risk. because low is a relative feature. So it's low relative to 55. If it goes to 10, it's going to seem high. So if you're going to make a call about the future of a commodity, and you think, well, that's kind of the bottom isn't the bottom until we reach the number where it can't go any lower. So I'm not telling you that this isn't the bottom in oil, and I'm not saying that we haven't discounted a whole bunch of bad news in Canadian economy and Canadian bank stocks in particular, and that you may want to sort of venture in there and start looking for some stocks that look attractive to you. But what I would say that whatever capital you commit to the stock market now, that you be playing a long game. So when I was trading for the banks that I worked for and the other financial institutions that I worked for, I always wanted to know what my downside was, and I always wanted to know what my upside was. So I had a particular model, a model to trading. I knew when I liked to buy things, and I knew when I liked to sell things. And I was very confident in my approach to it. I had honed it over 20 years, and I felt very confident about the way I could generate profits trading in that style. But it only worked if I did it all the time. So whatever your approach is to the market, if you're a long-term value investor, which I think most retail people are, retail investors are, then you need to continue to use that approach even when things are getting hairy, and it's not easy. Okay, so if you're a long-term value investor and you look at some blue chip Canadian stocks or some blue chip US stocks, and you're confident that they'll be here in 3, 5, 10 years from now, which is really 10 years is sort of I think the minimum window that a retail investor needs when looking at equities, then you need to maintain that confidence and sort of maintain that strength of will as you go in and make your purchases, bearing in mind that you could be wrong initially. Okay, Warren Buffett says all the time that when he likes a stock, he'll go in and he'll buy it, but he's prepared to be wrong a lot. So he's prepared to be early by 10, 20, 30%, and it doesn't really matter to him if he really believes what he's, the kind of analysis that he's doing. So whatever model he's using to pick stocks, he really believes in it, and he believes in it whether things are going up or whether things are going down. So whatever approach it is that you take to equities, you need to maintain it even when stocks are going down. Okay, so now this is not the time to be buying speculative names. I would say that that sounds like a piece of advice, but you certainly can do it if you're a super high risk person and you're prepared to withstand the losses that can come from investing in risky assets right now, if that's your style. But I'm imagining most people are pretty conservative. We're talking about RSP investments and tax-free accounts and things like that. So if that's your approach and you commit money to the market now, continue to use the same approach that you've always used, and be prepared to ride it out. Part of the way I used to manage risk and sort of not let all the dynamics of the market gobble me up was not to just sort of stare at the prices every day, all day, every day, even though I worked in front of a trading screen and multiple trading screens. Once I committed some capital to a trade, I would try to step back and just not try to watch the day-to-day prices or the minute-to-minute prices, because it clouded my judgment and just got me more emotional about the trade, and took me out of that sort of long-term focus that I wanted to have and that long-term model that I had built for myself. Okay, so if you're going to commit some money to the stock market or whatever it is that you're buying, commit it, understand what your downside is, ask yourself if it's consistent with your long-term approach to investing and managing risk, do it, and then leave it. Okay, and you can come back to it. You can always reassess it if there's some really mega drastic, drastic move or change in policy or something like that in the markets. But I think we've more or less discounted a lot of that, a good portion of it right now. Again, but that's your judgment to make. But I would say, as a risk manager, your own personal risk manager, is to not watch these day-to-day movements in the market. Number one. Number two, whatever your long-term investing and philosophy is, to maintain it even in down markets. Okay, so for people who, common retail practice is to do what's called dollar cost averaging. So that means you buy a little bit every month. There's probably a few people out there that are buying a little bit of stock every month. And that's a really sound way to invest as a retail investor. And I would strongly encourage you, if you can, to continue to maintain that strategy. If you're comfortable with it, because the only way you buy low and sell high is to buy low. The thing with buying low is you're doing the opposite. You're doing the opposite. Just hang on 1 second. You're doing the opposite of sort of what the market's doing. Okay, so to buy low, you have to be buying when everyone else is selling. To sell high, you have to be sell when everyone else is buying. To buy low, you have to be buying when everyone else is selling, and to sell when everyone else is buying. It's very difficult. You're always swimming against the stream. So, but that's the sound. That's a sound approach to investing and trading and managing risk. So I think a couple of Q&As have popped up here. Some of my friends are saying it's wise to invest in gold at times like this. What do you think? So gold is, again, this is just my opinion. Talk to your financial advisor. Gold is, and yes, historically in times of high conflict and market dislocation, which is a sexy way of saying when the shit's really hitting the fan like it is right now, people rush to gold because it's got a historical store of value. Okay, so historically people have run to gold. When things really come apart like they are right now, it doesn't work, at least in the short term, because people sell everything. Okay, so we say everything, we say the assets have a correlation of 1. That means nothing is going up while something else is going down. The market just sells everything, participants sell everything because they need to raise cash. So they sell stocks, they sell bonds, they sell oil, they sell cotton, they sell gold, silver, they sell Bitcoin, everything is coming down, okay, because people need to raise cash. Okay, so since this has started, I don't think gold's actually moved. It's around $1,500 US an ounce either side. And I think it was actually a little bit lower than that last time I looked. So people would say, well, why is that happening? Isn't it supposed to be a sort of safe haven? And I would say, yes, historically it is, but not when things go this crazy. Having said that, personally, I've never been a fan of investing in gold. It's a shiny metal that doesn't pay dividends or interest, but gold is an emotional trade. People either feel strongly about it. They have this really strong urge around gold, which that in and of itself makes me nervous because I don't like to be emotionally attached to trades. I don't like to be emotionally attached to investments. So gold has a bit of an emotional vibe to it. People either love it or hate it or are aggressively indifferent to it, kind of like me. So just be wary of that, okay? How you choose to invest in gold is another question. So you can buy gold stocks, so companies that mine gold like Barrick and Newmont and things like that. Now you're investing in the management of the company, and that's a little bit more complicated than just buying gold bars, okay? One thing I do want to point out about gold, because a couple of people have asked me about this. And I can answer this more clearly offline, but if you invest in gold as a Canadian, as a domestic Canadian, there is a foreign exchange risk involved in that trade that I think most people don't understand, okay? And I won't get into it here. I can talk about it with you offline, or maybe you can ask your financial advisor about this offline, but gold trades in US dollars, and we are sitting here in Canada with Canadian dollars to invest. So, gold can stand, if you choose to invest in gold as a Canadian investor, the price of gold can stay flat or even go up, and you can still lose money if the foreign exchange, if the US dollar, Canadian dollar foreign exchange rate moves against you. And there's a specific way that it would move that would hurt you. Again, I don't want to get into the dynamics of that, but there is more risk involved in that trade than just simply buying it at somebody's typing $15.39 an ounce today and watching it go up. So yeah, gold was $1,700 2 weeks ago. Roger's telling me. I think I saw it trading on a 14 handle a few days ago also. So, you know, the thing's moving around. I'm not telling you whether it's good or bad. Historically, it's a good store of value. If you like it, buy it. Just be aware of all the risks, including the foreign exchange risk that's involved in that, okay? Another question, there's a lot of conflicting advice out there about investment strategies right now. Who do you listen to? Which media sources do you trust for sound advice projections? Are there some we should avoid? So basically, CNBC is my source for you know, what's going on in the markets and approaches to that. It's pretty unbiased. They can be a little cheerleadery at times because, you know, they They generally want the stock market to go up, but there's some really good, they get really good guests on there, really smart guests, really good panelists, particularly if you watch in the morning. Between 7 a.m. and 9 a.m. They get the Treasury secretaries on there, really powerful investment managers are on there, very, very, very smart people. If I was going to watch one piece of news or one news outlet to get sort of a good handle on what's going on in the market, it would be CNBC, and I'd watch it between 7 and 9 a.m. in the morning. Are there some we should avoid? Oh boy. Try to avoid just the bantering, like the sort of, and that mostly happens in the Twitter sphere and Facebook groups and things like that, where everybody's got their 2 cents. Everybody's got an opinion about where the stocks are going or where equities are going, or interest rates or things like that. And honestly, it just, what I was talking to you earlier about, if you commit your capital, just kind of push it away and stand back and don't watch all the price action. Don't listen to all the chatter either. Okay, I've talked myself out of more good trades and talked myself into more bad trades by talking to other people in my career, until I finally figured out I knew what I was doing and I was confident with it, and I had a good approach to risk management, and then I just did my thing without getting clouded from other people's opinions. So who do you avoid? Sort of the nattering masses. Okay, that's basically what I would say. If I'm a long-term value investor, I want to follow other long-term value investors that I respect, and of course, Buffett would be one of those. Bill Miller's another one. These are people who've been value investing in the U.S. stock market for decades. They've seen it all. To them, these are buying opportunities, and if you value their judgment and you value their opinion and you respect them, then you can certainly follow voices like that. Okay. I had another question from somebody who emailed it in this morning, asking me about investing in foreign equity funds. So again, so these are like emerging market funds, I think was the question. And this was a portfolio that was pretty heavily invested in emerging markets. Again, I'm not going to give you advice as to whether that's a good investment or a bad investment. Historically, emerging markets, and by emerging markets, we mean things like Brazil and parts of Southeast Asia, South America, even Africa, Eastern Europe. These are considered emerging markets because they're not fully developed in the way that Canada, the US, Britain, Germany, things like that are. So you can make a lot of money in those markets, but the opportunity to make a lot of money in those markets also comes along with a lot of risk. So if you are the type of person who is prepared to take that risk, and those markets have probably been beaten up even more than our domestic markets have been, and by that I mean stock markets, then there's probably some opportunity there. But again, I don't know anybody who knows what the economic fallout of this event is going to be, particularly as it pertains to global trade. Okay, so emerging markets are going to have a whole extra layer of risk that they, in addition to all the risk that they had before. Okay, quite often they have unstable governments, their currencies can be very volatile, all sorts of things can happen in those markets at the best of times, and this is like the opposite of the best of times. So, stepping into emerging markets right now, I think you really need to be very brave, and I would only do that if it really suited your long-term risk profile. Okay, so just basically when you're approaching these types of markets, I would say do your homework, like know what you're getting involved in. Okay, if you're going to invest in an emerging market ETF or mutual fund, know what that emerging market ETF or mutual fund is investing in itself. Okay, is it South American emerging market? Is it Eastern Europe mutual fund? Is it one that takes a global approach to emerging markets, so it sort of spreads the risk around a little bit? I mean, the sort of onus is on you to know where you're putting your money at work. And if you don't know, or you're unable to find out, or you don't have the time, or you just don't want to, then don't do it, would be my suggestion. Like, know where you're putting your money. okay, and understand all the risks that are associated with that. Yeah, so you'll give yourself the best solace. You'll be able to sleep at night and put your head on the pillow with the sort of the highest degree of confidence. If you've made sound decisions, you've made them consistent with your long-term approach to managing risk, and you've given yourself the best chance of success. Okay, we can't get rid of all the risk. We can't guarantee ourselves any sort of outcomes here. But you will be able to give yourself that put the head on the pillow feel if you've done your homework and just mitigated your own personal risk as much as you can. That was, again, that's that was really a big learning for me, and just a big approach for me in my institutional days, was just sticking with my program all the time. Okay, I don't think it does anybody any help to say, try and remain calm and relax. Precisely 0% of the people in the world, when they're excited and people tell them to relax, actually relax. Like I know it's not that easy, but there is another side to this. We will get through all this stuff. The financial markets will, the economy will, our governments will, our individual businesses will. There's an individual, there is another side to this story. I don't know when, but I know that if we make sound decisions, and use the best judgment that we can. We're not going to make the best choices all the time. You never do. But if we make the most sound decision with the best information that we have, to me, I can put my head on the pillow at night and get some sleep if I've done that. Okay. If I'm just taking flyers and just taking shots in the market, it's never felt right to me. And I think that would make you probably more more upset than we kind of are already. Okay, so I don't know if anybody else has any other questions pertaining to the markets or approaching risk. Pete's sitting here with me. Pete, do you have anything?
No, I've chatted with you offline. Yeah. A bunch of stuff.
Yeah. Yeah, that's kind of it. Like what I would say just generally again is stick to your long-term approach, whatever that is. Continue to talk to your financial advisors. Try to maintain that approach even though things are getting really hairy right now. I mean, this is when opportunity starts to show itself, and be prepared. Whatever capital you commit to the markets, be prepared to ride it out, because you're not going to catch the bottom. Yeah, Pete's a good 8 feet away. He's at the other end of the table. So.
Actually, you did make a good point about sticking with it and investing, a long-term plan.
Yeah.
Because history shows that it always comes back.
Yeah, I mean, I can share a little bit of data with you in terms of trying to help you try to make those sound decisions. So if you look back, here's an important way to look at stocks, okay? It's in 10-year rolling returns. And I'll explain a little bit about what that is. So if you take a snapshot of a 10-year return of the stock market, it's going to have some number to it. It could be in this 10-year period from, say, 2000 to 2010. It could be, so I'll just answer this question. The name of the strategy where you make small investments every month is called dollar cost averaging, okay? And what that means is that you make a fixed amount investment, so a fixed dollar amount investment every month, okay? And the hope of doing that is when you invest, say, $100 every month, when stocks are high, you buy a little bit of stocks, and when stocks are low, you get to buy more stocks, okay? Because you're dollar cost averaging into your position. And over time, you will be able to accumulate your stocks at an average price, okay? So if I see this little picture here, and if stocks are kind of going up in this herky-jerky fashion, what I want to do is try to earn myself this average price, okay? I don't want my price to be all at the top, and I'm not going to be lucky enough to have it all at the bottom. But if I just make periodic purchases over time, then what I will do is earn myself this average price, this straight line price, okay? And that's a good conservative approach to investing. It means you don't have to time the market. You don't have to overthink it. When things are high, you buy some, and when things are low, you buy more, and you just keep on chipping away. Long-term approach to investing, okay? So this 10-year average rolling returns. So we can take a 10-year snapshot. Do you make it on a certain stock? I wouldn't, personally, because then all my eggs are in one basket, okay? If we're gonna take a conservative approach to investing, we would invest in a broad index, okay? So you can find an ETF or a mutual fund that tracks a broad index like the TSX or like the S&P or something like that, okay? So if you certainly could do it on an individual stock, but then all your eggs are in one basket. And if that you're okay with that and it suits your profile, then fire away. It's still a good approach. Better than just sort of buying all at one time. So for instance, if you made your purchase just on January 10th every year, you're always in at that price. If stocks go down, I don't get to participate in that, in being able to buy more. So I want a dollar cost average my way into this price, okay? So 10-year average rolling rate return. So if we look at any 10-year bracket, say from 2000 to 2010, it might have a positive return, okay? Say, or I earn 10%. And then if I look at the next 10-year bracket from 2010 to 2020, it's gonna have another return, okay? But I'm leaving all these other individual 10-year windows out of the picture. Okay, so an average 10-year rolling return will look at the return from 2000 to 2009, to be exact. And then the next 10-year window is 2001 to 2010. And then the next 10-year window is 2002 to 2011, and on and on and on. Okay, and that gives me a much more granular look at the market, right? So if we go back to 1900 and look up until today, and you can find this on, if you just Google S&P 10-year average rate rolling returns, you'll get lots of sites that, that will give you this data. The average return is around 10%. Okay, so from 1900 to 2020, a lot of crazy things have happened in the world. Okay, famines and flu epidemics and world wars and cold wars and meltdowns and oil embargoes, it's all in there. Okay, so if you're a long-term investor, you know, you're should theoretically do okay within these 10-year average rate rolling returns, because the average of all those returns is around 10%. Now you need to have at least a 10-year window, and there's no guarantees, of course, but that's, you know, that always gives me some solace because markets rebounded from everything, but you do need to have a long-term perspective. So these are the types of things that I would look at as I'm trying to just get my arms around risk. And the risk as it is today. But that's reasonably compelling, I would think, for most retail investors. Again, your situation may be different. I think a lot of people on this call are not staring retirement in the face in the next 5 years. Maybe are, I don't know. But you know, if you have at least a 10-year window, it's probably not bad. Again, individual choice, you need to make that. But that's the type of data that I would look at to help me make my choices. Any other questions? Okay, I hope everybody continues to practice their social distancing and do everything we can to keep each other healthy. Oh, I did have a question. If you are drawing already on your investments, what should you do? I think what that question means is that if you're living off your investment portfolio, what should you do? To the extent that you don't need to sell any principal, I think this is not the best time to be selling. So if you can continue to live off dividend income or investment income or things like that, that would be the most prudent approach. So if you're living off your investments and they're kicking off dividends, just continue to collect the dividends. And as I said, don't watch the prices and just let this thing all play out. If you need to sell some principal, you know, do it as little as you can, I would say, for obvious reasons, right? We're selling into a 30% decline. So, but you need to manage your individual situation. Yeah. So, okay. Basically, another question. Hang on. Yeah, I can certainly answer any questions about what we're doing at ACE. If you have those. Basically, Nancy and our approach is, we're trying to balance the needs of our members who are continuing to work and do business. We want to support them, and we need to balance that with supporting community health. So we struggle with it as much as we have to try and make that balance. None of these decisions are easy, but that's kind of the approach that we're taking. We need to support people, and we need to keep everybody healthy. So for now, as you would have all seen in the communications, we are closed to the general public, open for our members, and pleading with everybody to continue to practice social distancing and taking all the precautions that you need to take. But for now, we'll continue to support people by staying open for our membership. We'll add more virtual connections with people, more virtual events and things like that, just because I think we're in for a bit of a long haul in terms of staying apart, and this business is built on bringing people together. So we got to find another way to do that. But yeah, continue to maintain your discipline. I guess here's my parting gesture. Try to continue to maintain your investing discipline. It's hardest when things are like this. It can also be hard when things are really flying at the top too, because then you can tend to get a little loose, right? And you maybe start to make some investments that you wouldn't typically make because you're feeling more wealthy and you're feeling smarter. You feel like you've got it figured out. And that happens to institutional investors and so-called smart money, just as it does to everybody else. So I would caution you at the same thing at the top, just to maintain your discipline. And that philosophy also is important at the bottom, or when things are going down significantly, is to maintain your discipline, maintain your long-term approach, do your homework, talk with your financial advisor. To the extent you can take the emotion out of everything, do it, particularly when it involves money and assets, because money has no emotion. It just flows to places where it gets the biggest return, and it doesn't cry and it doesn't scream for joy. It just does what it does. So to the extent you can just step back and be prudent, and take a long-term approach to this risk management, you'll give yourself the best chance, okay, which is all you can really ask for to manage your way through this financially. Okay, there is another side to it, meaning we will get through all this. There will be happy days, there will be up days in the stock market. We want to be around to participate in it. Okay, so Nancy and I are just incredibly optimistic about the future. We want to share it with everybody. We will. You'll all be here. We'll all be here. It's going to be, it's going to be a really good time on the other side. We just all need to get there. Okay. So thanks for dialing in, everybody. I hope I answered your questions. I hope I was able to add a little clarity to some of the concerns you had. If you want to follow up with me offline and have a conversation, that's cool too. You can email me or call me, or if you're a member, next time you're in here, you can have a chat. Okay, and we'll see you when we see you.